Hello, everybody. This time we are talking about a production budget. A production budget is a document that calculates the number of units of a product will be manufactured to meet the estimated sales demand. Manufacturers make a production budget quarterly through sometimes they will also be produced on a monthly basis. A production budget doesn't involve inventory costs. It is merely a budget of units of a specific product that needs to be produced over a time period. In order to produce the right amount of products units, manufacturers need to forecast their future sales figures and also include the number of units needed for them to sell in order to make a profit after labor and material costs. A production budget is a component of the production plan, which is a more thorough document that describes all the aspects of production such as scheduling and costs. And then, how is the production of a company determined by the production budget? To determine how much to manufacture, a company must first calculate the sales budget before creating a production budget. In this regard, the consumer demand for a new product can take time to predict when creating a sales budget. So, to find out how much other companies are charging for similar products, conduct market research. You can also leverage historical data from previous sales if a product is well known. Also, it's necessary to evaluate any shifts in the economy that can have an impact on your company. And then we move to types of a production cost budget. The production cost budget can be of three types. The first type, direct materials budget. The number of direct materials needed to meet production demand is estimated by the budget for direct materials, and it is included in the organization's material requirement planning. The quantities of raw materials are calculated for the direct materials budget based on the year's production goals and closing inventory. And then second, direct labor budget. The direct labor budget, as its name implies, deals with the expense of direct labor used in manufacturing, assembly, or service. This budget details how much direct labor will cost and how many hours it will take to produce or provide services. And then the third, production overhead budget. All manufacturing expenses except direct labor and material costs are included in the production or manufacturing overhead budget. The data from this budget is added to the master budget's cost of goods sold item. The sum of all expenditures in this budget is translated into an overhead budget for each unit. The cost of the final finished goods inventory is calculated from the overhead budget per unit and then shown on the projected balance sheet. given it may include a significant portion of a company's total spending. This budget information is among the most crucial of the different departmental budget models. And then we move to the components of a production budget. The first component, beginning inventory. A firm's beginning inventory is composed of the remaining units from the last budgetary period. This would be the previous period's ending inventory. Generally, a budgetary period will consist of a year, quarter, or month. Although this is not a requirement, it can be another time period. And then the second, targeted ending inventory. Ending inventory is composed of the inventory which is left over at the end of a period. Management generally has a targeted amount of ending inventory left over at the end of a period. At the start of a new period, ending inventory becomes the beginning inventory of the new period. Most firms will retain a small stock of inventory, referred to as a safety stock, in case it is needed. This stock is added to ending inventory at the end of a period. And then third, forecasted sales. A sales forecast is generally created prior to a sales budget. This forecast predicts how much of a product the business believes will be sold in the budgetary time frame. This is a crucial step as falling short of demand can result in missed opportunity and damage to customers' goodwill, and holding on to excess inventory can result in higher storage costs and inventory becoming obsolete. And then fourth, required production. The number of products that will be required can be determined by adding the sales forecast and the desired ending inventory and then subtracting the beginning inventory. After determining the final production budget to find how many units will be produced for a period, cost accounting can be used to find the exact cost of what will be produced. The cost of raw materials, direct labor, and overhead attributable to the product will each be accounted for in their appropriate accounts. And then we move to importance of a production budget in accounting. The first, the production budget forms the basis of planning in any corporate undertaking. This form of budget helps in streamlining the production process and machine utilization. And then the second, the production budget also helps in the proper and effective utilization of available resources. And then the third, the budget also helps in taking managerial decisions in purchasing raw materials and other consumables. And then fourth, the production budget also helps in controlling the expenses that is to be incurred while producing a product and setting a clear objective for the people in the organization. And then fifth, the budget helps the management to take key decisions in hiring new labor force depending on how much production is to be done by the company in the coming period. And then we move to the challenges in coordinating sales and production budgets. There are some common challenges that businesses may face. The first about uncertainty in sales forecasts. Accurately forecasting sales can be challenging due to the inherent uncertainty in market conditions, customers' demand, and competitive dynamics. This can make it difficult to prepare an accurate sales budget, which is in turn affects the production budget. And then the second, communication and coordination. Effective communication and coordination between the sales and production teams are crucial for aligning the sales and production budgets. However, this can be challenging due to differences in priorities, goals, and perspectives between the two teams. And then, third, about production constraints. Production constraints such as limited production capacity, raw material shortage, and labor availability can affect the business ability to meet the sales forecast. This can lead to situations where the business either produces too much or too little, leading to excess inventory or stock out. I think this is enough. Thanks for watching.